Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. As we look ahead to 2026, it's important to recognize that the strategies we've relied on to protect or grow margins in the past might no longer be effective. What once worked as a margin playbook could now become a trap, putting profitability at risk. The image here, showing a red arrow pointing downward over shrinking stacks of coins, highlights this challenge visually. It's a clear reminder that if we don't adapt our approach, margins could decline significantly. Throughout this presentation, we'll explore the key factors driving this shift and discuss how to navigate these new risks to safeguard and improve your margins moving forward. In 2024, companies often protected their earnings by using familiar tactics like freezing hiring, renegotiating procurement contracts, cutting travel and discretionary spending, and simplifying product lines, along with pushing for productivity improvements. These approaches were understandable given the environment of volatile demand, higher costs, and uncertain capital availability. However, looking ahead, the pressure on margins hasn't gone away, it's shifted. The real risks now lie in factors like revenue quality, supply chain resilience, customer retention economics, and productivity gains driven by data and AI. Simply cutting costs like before won't be enough anymore because the challenge is no longer just about having too many expenses. Instead, it's about having the wrong cost structures, weak pricing power, fragile operations, and not investing strategically in capabilities that create competitive advantage. To address this, organizations need to shift focus from cost cutting to designing smarter cost structures with a discipline on cost to serve, prioritize profitable growth through better pricing, product mix, and customer retention strategies, and move beyond just efficiency projects toward building capabilities that compound over time, especially by leveraging AI, automation, and operational resilience. This approach, which we'll explore in detail with practical examples and a playbook, will help protect margins and shareholder value through 2026 and beyond. Margins tell us more than just how a company is doing financially. They actually send a strategic signal about the business's health and potential. Improving margins sustainably usually comes down to a few key areas that businesses can control. These include having pricing power through value-based pricing and smart discounting, shifting the product mix towards higher margin offerings, matching cost to serve with the economic value of customers, and making better use of assets by improving inventory turns and utilization. It also involves operating leverage, where the balance between fixed and variable costs is aligned with demand, and building unique capabilities in processes, technology, data, and talent that competitors can't quickly replicate. By 2026, investors are looking for companies that show quality of earnings, profits that are stable, repeatable, and based on a sound strategy, rather than one-off cost cuts or temporary fixes. For management, this means focusing less on short-term cuts and more on designing a system that consistently generates strong margins. The images here give a practical sense of what that looks like: data dashboards showing performance metrics and business analytics, as well as market data that reflects how thoughtful strategy translates into shareholder value. Many companies approach cost management in 2024 by implementing broad cuts like reducing SG&A expenses, pausing hiring, cutting vendors, or consolidating offices. While these moves may offer short-term relief, they often cause longer-term problems such as slower lead times, decreased quality, reduced sales capacity, and underinvestment in service, all of which can erode margins and customer loyalty. The shift for 2026 involves moving away from these broad cuts toward what we call cost design, tailoring your operating model to align spending with where value is actually created. The core idea here is cost to serve, which recognizes that not all customers or products contribute equally to profit. For example, two customers might pay the same price, but one might order smaller batches more frequently, require custom packaging, need faster shipping, or generate more customer service requests. These factors increase costs and reduce the true profitability, even if the gross margin looks healthy. By understanding and designing around cost to serve, companies can better protect and grow their margins by focusing on profitable customers and products, rather than using a one-size-fits-all approach to cost cutting. To manage costs effectively in 2026, Start by building a simple cost-to-serve model that allocates logistics, handling, returns, support, and selling costs by customer, product, or channel. This helps you identify profit peaks where you gain margin and profit pits where you lose it. Then segment your customers based on economic value, using contribution margin and growth potential rather than just revenue, dividing them into A, B, and C tiers. Introduce service level menus where a standard service is included, but premium options like faster delivery, customization, or dedicated support come with explicit fees. Review policies that often cause profit leakage, such as minimum order quantities, return policies, free shipping thresholds, and payment terms, and redesign them thoughtfully. Work on reshaping your fixed and variable cost mix by outsourcing activities that don't differentiate your business, standardizing processes, and automating repetitive tasks. Retailers and e-commerce firms have learned that offering free and fast delivery without optimizing basket size or fulfillment can damage margins. So many now use thresholds, memberships, and regional fulfillment strategies to stay profitable. Similarly, B2B manufacturers improve margins sustainably by rationalizing SKUs and standardizing components instead of just cutting headcount, since complexity creates ongoing costs. In SaaS, firms that cut customer support too sharply risk increased churn. So tying support tiers to customer value and pricing them appropriately preserves margin and satisfaction. Ultimately, protecting your margins in 2026 means designing the cost to serve system smartly rather than only focusing on cutting costs. Many companies have treated growing revenue as the solution to margin pressure, but focusing solely on volume can actually hurt margins when it comes from heavy discounting, expanding into low margin channels, acquiring unprofitable customers, or increasing product complexity. The shift we need by 2026 is to prioritize profitable growth instead of just any growth. This means we need to treat pricing, product mix, and customer retention like important assets that we actively measure and manage. For pricing, the issue usually isn't just the price itself, but the system around it. Things like inconsistent discounting, weak oversight, and sales incentives that push volume rather than margin. To fix this, companies should set clear discount limits, establish approval workflows, and use deal review boards, while also offering bundles based on the value customers get, not just product features. Contracts should be updated with clauses that allow for price adjustments or minimum commitments where it makes sense. When it comes to product mix, margin often depends on which customers, products, or channels are growing the fastest and most profitably. It's important to identify those high margin products and protect them from unnecessary discounts. Focus go-to-market efforts on segments willing to pay sustainably, and carefully cut back on SKUs that cost more to manage than they bring in. By managing both pricing and mix strategically, companies can shift from chasing revenue volume to generating real profit growth. Acquiring customers costs a lot, but losing them can have an even bigger impact on profitability. Often the easiest way to improve margins is by focusing on retention and reducing returns, which are frequently overlooked factors. To address this, it's important to understand the real costs associated with churn and product returns, as these can quietly erode profits over time. Investing in areas like customer onboarding, success programs, and product quality improvements can pay off, but only when the return on investment is clear. Tracking metrics like revenue retention and net revenue retention helps keep margin protection front and center in decision-making, ensuring efforts to hold on to customers translate directly to better financial results. This approach safeguards margin by keeping customers engaged and reducing costly losses. Subscription businesses have shown us that improving retention through better onboarding, clearer communication of value, and targeted customer success efforts can significantly expand lifetime value without driving up costs. In the consumer goods sector, simplifying product portfolios to focus on the most powerful SKUs often leads to better margins by reducing complexity, enhancing marketing efficiency, and improving shelf positioning. Airlines and hospitality industries offer classic examples of profitable growth by focusing on revenue management and dynamic pricing, shifting the focus from just increasing volume to optimizing yield. The key takeaway for 2026 is that defending margins will depend much more on pricing discipline, improving product or service mix, and managing retention economics, rather than simply pushing for higher sales volumes. This strategic shift requires a more nuanced approach to growth that balances revenue with profitability. Many organizations have relied on transformation projects that brought short-term savings, but those gains often didn't last. These included one-time procurement wins, isolated automation pilots that weren't scaled, disconnected dashboards offering limited insights, and cost-cutting programs that didn't redesign processes. By 2026, the focus needs to shift toward building capabilities that compound over time, systems that continuously improve productivity and resilience every quarter. The key areas to focus on are AI-enabled productivity, which goes beyond just adding tools to rethinking and redesigning processes, end-to-end automation to eliminate repetitive rework loops, resilient operations that reduce the cost and impact of disruptions, and improving decision velocity, which means making faster, more accurate resource allocation decisions. This approach helps move away from one-off fixes and towards sustainable growth and agility. Start by identifying 3 to 5 key process value streams that directly impact your margin, such as quote to cash, procure to pay, plan to produce, order to delivery, or customer issue resolution. Measure the friction in these processes by tracking cycle times, handoffs, rework, exceptions, and errors, because friction represents a leak in your margin. Before introducing automation, redesign the process to avoid scaling inefficiencies or problems. Apply AI strategically where it has proven economic value. For example, use it for support functions like triage and knowledge retrieval, sales activities such as proposal drafting and account research, finance tasks including variance analysis and anomaly detection, and operations like predictive maintenance and demand forecasting. It's also critical to build governance around these tools, ensuring risk, compliance, privacy, and auditability, especially in regulated industries. To sustain momentum, create a capability flywheel by reinvesting savings into further automation and improving data quality, which helps teams learn, standards mature, and benefits compound over time. Real-world examples illustrate this well. Manufacturers reduce downtime through predictive maintenance. Professional services gain efficiency with standardized proposal and delivery processes, and supply chains increase resilience through better planning and diversification. Ultimately, margin leadership in 2026 comes from developing capabilities that continuously build on each other, rather than relying on one-time savings. Start by gathering your finance, operations, and sales teams into one margin-focused space to diagnose where margin is leaking. Use a margin bridge that breaks down price, volume, mix, cost to serve, and productivity to get a clear picture. Create a heat map ranking customers, products, and channels based on their contribution, and identify the top 20% profit leaks by financial impact. During this early phase, focus on building a quick but reasonably accurate model to guide your decisions. In the next phase, prioritize fixing the biggest leaks that can be addressed quickly with high impact and minimal risk to customer experience. This might include tightening discount controls, adjusting freight or returns policies, introducing service tiers, removing unprofitable SKUs, renegotiating contracts, or automating a high-volume administrative process. Finally, in the last phase, establish a new operating rhythm with weekly margin reviews and monthly pricing council meetings. Develop a capability plan to improve data quality, redesign processes, and build an automation backlog, along with a reinvestment policy to allocate a portion of savings back into these improvements. By following this roadmap, you shift from constantly chasing margin to building a system that consistently protects and grows it. Focusing on this strategy shift leads to more durable margins because it addresses underlying structural issues rather than just cutting costs temporarily. It also improves the quality of earnings, which investors appreciate since repeatability and resilience are key factors they look for. Another benefit is that it enhances customer profitability by preventing us from unknowingly subsidizing high-maintenance customers. Resources like capital and talent are better allocated to areas that truly create value, and the combination of automation with process redesign drives ongoing productivity improvements over time. However, This approach does require stronger cross-functional leadership, since pricing, service levels, and cost to serve cut across different departments, and resistance can be expected. There may also be short-term friction with customers, especially when introducing service tiers or tightening discounts, so it's important to handle these changes carefully. Data limitations can pose challenges early on, as cost to serve modeling and mix analytics might be complex at first, so starting simple is key. Additionally, if teams have experienced multiple cost programs before, they might be skeptical, leading to change fatigue, which means clear communication and visible quick wins become crucial. Lastly, while AI and automation can boost productivity, without strong governance, there's a risk of errors, compliance problems, or even damage to the brand. So controls must be built into these processes from the start. Cost-cutting approaches that worked in 2024 can actually harm margins in 2026 because they often undermine key strengths like pricing power, customer loyalty, operational resilience, and speed in decision-making. To protect shareholder value, organizations need to change their mindset. Instead of just cutting costs, they should design costs strategically. Instead of focusing on volume, they should optimize for profitable growth. And rather than running isolated efficiency projects, they should build capabilities that grow and strengthen over time. Making these three strategic shifts will help create margins that last and build a business that can invest and thrive through volatility. While your competitors may continue cutting, your focus on designing costs and capabilities will give you a sustainable margin advantage. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.